Welcome to the FMLS Market Intel Report. I'm Leslie Appleton-Young, FMLS Chief Economist. As we await the arrival of the spring market and anticipate the outcome of the March meeting of the Federal Reserve, it's a good time to review the February 2026 stats for the greater Atlanta area. Given the trend in pending sales the past few months, February's 4.5% decline in sales year over year was not surprising. With the majority of these sales initiated in January and December, the 3.8% year-over-year decline in pendings in December and the 6% year-over-year drop in pending sales in January gave a very strong indication that we would see a slow start to 2026. Taken together, the first 2 months of the year are down 6.3% over last year. Inventory continues to grow with slightly more than 12,000 homes for sale in the greater Atlanta area, and at 3.6 months, supply is at its highest level in over 7 years. Days on market has been rising since 2023, and at 32 days is just shy of pre-pandemic February 2019. Finally, prices continue to rise slowly, with the average sales price hitting an all-time high for a February of $560,410. The Fed meets in just a few days, and needless to say, they have a lot to consider. On the jobs front, the March 6 jobs report from the BLS was a stunner. 92,000 jobs were lost in February compared to an expected gain of 50,000, while the unemployment rate edged up to 4.4%. The decline was broad-based as employers assess the impact of back-and-forth tariff policies, the potential for AI to shift hiring needs, and as the federal government continues to shed jobs. After the healthy gain of 130,000 new jobs in January, the February reading awakened concerns about the fragility of the labor market. On the inflation front, the bombing of Iran has heightened geopolitical uncertainty around the globe and at home, exacerbated inflationary expectations. Oil prices have risen sharply, with crude oil prices surpassing $100 a barrel as of March 8th, a 30% increase since the bombing began on February 28th. The fear of supply disruptions fueling renewed inflation may exceed the reality, but as we have seen in the past, expectations can have a real impact on the economy. Markets have already begun to scale back expectations for rate cuts in 2026, and it is all but certain that the Fed will keep rates at their current levels at the March meeting, noted NAR Chief Economist Lawrence Yun. The big question going forward is whether a recent rise in oil prices could push the economy into stagflation. The ugly combination of low economic growth and elevated inflation will also mean higher mortgage rates. Which raises an important question. What does this mean for mortgage rates? Recall that on February 26, Freddie Mac reported its 30-year rate was 5.98%. The first time it had dipped below 6% in well over 3 years. On March 2nd, the day after strikes began, it jumped to 6.12%, returning back to 6% by March 5th. Mortgage rates are determined by the 10-year Treasury bond yield and the spread or risk premium investors demand for holding mortgage-backed securities over Treasuries. The 10-year government bond yield is primarily determined by market expectations about the economy and monetary policy. Today, the mechanism driving rates up is oil, not the typical flight to safety dynamic. The Iran war is driving up global oil prices, fanning concerns about rising inflation, which in turn is pushing bond yields and mortgage rates higher. The 10-year Treasury climbed from 3.96% on February 27th to 4.14% on March 5th. This means higher mortgage rates. For the spring housing market, the concern is real, but experts today are cautiously optimistic. If the conflict is limited in duration, higher energy prices and mortgage rates could be temporary, and the spring buying season could be delayed rather than derailed. But if it drags on, major energy disruptions would keep inflation and rates elevated for longer. Only time will tell. Take a look at market intel on the FMLS website to access the most current market statistics. They are updated weekly. If you're interested in resources relative to our market dynamics and want to dive into local markets, we've got you covered. For FMLS Market Intel, this is Leslie Appleton-Young. See you next time.